Ever tried to trade a cow for, I don't know, maybe a few sacks of grain? You'd need to find someone who not only needs a cow like crazy, but also has extra grain they're willing to trade.
Not easy.
It's tricky, right?
Yeah, that's the problem barter societies had to deal with.
And that's what Ludwig von Mises really digs into in his book, The Theory of Money and Credit.
A classic work in Austrian economics.
So how do we escape the barter system? Did some king or emperor just decide, hey, we're using money now?
Well, Mises actually argues against that.
Wow.
His regression theorem proposes that money didn't come from like a government decree or anything. It kind of developed naturally from just how markets work.
That's so interesting. So
Yeah.
how does a society without money suddenly decide that, say, shiny rocks are now what everyone will use to trade?
Think about what makes something like gold special. It lasts a long time, you can divide it up, it's easy to carry around, and it's relatively scarce.
Okay.
People already valued gold, for jewelry and stuff like that, so it already had value.
So gold wasn't valuable because it was money. It became money because it was already valuable for other things.
Exactly. And as people started using gold to trade, its value as money just got stronger. It's a great example of how social institutions can evolve naturally from what individuals do in the market.
This is totally changing how I think about money. It's not just bills and coins. It's like a social thing with a history tied to actual value. But money does more than just let us trade, right?
Well, sure. We use it as a medium of exchange, like we've been talking about. But money also acts as, well, a unit of account and a store of value.
A unit of account, what does that mean?
Think about how we compare prices of different things, like apples and cars. Money gives us that common way to measure value.
Okay.
Without it, trying to set prices would be chaos.
So it's like a universal language for value, making it possible to compare apples and oranges, so to speak.
Exactly. And then there's the store of value function. Money lets you basically save up your ability to buy stuff for the future. You earn money now, and you can hold on to it, knowing it'll buy things later on.
But doesn't inflation kind of mess that up? Prices keep going up. The money I save today won't buy as much tomorrow.
That's the problem. Inflation eats away at the purchasing power of money over time.
So how do we even determine the value of money if it's constantly changing?
This is where the Austrian School of Economics, where Mises fits in, really stresses this idea of subjective value. The value of something, anything, isn't like built in. It's determined by how much people are willing to pay for it.
So the value of money is, what, all in the eye of the beholder?
It's a little more complicated than that. The value of money comes from what you can buy with it, its purchasing power, and lots of things affect this, like how much money is out there and how much people want to hold on to it.
So it's like a chicken and egg thing.
Yeah.
The value of money depends on what you can buy with it, but what you can buy also depends on the value of money.
It seems circular, right? But that's where Mises' regression theorem helps us out. Remember, the value of money started because it was a valuable thing in the first place, like gold. That starting point, that non-monetary value, that's what grounds its value today.
Okay, that makes more sense. So we've gone from bartering chickens to understanding how complex money is and that its value is kind of like subjective. But where do banks fit into all of this?
Banks are super important, but what they do can have some weird consequences. We talked about commodity money, like gold, but there's also credit money, which is basically a claim on some actual commodity. Think about banknotes or even deposits. It's like a promise to pay you a certain amount of gold or whatever on demand.
So kind of like an IOU for gold.
Exactly. And then there's fiduciary media, which is stuff that's like money but isn't fully backed up by reserves. This is where that fractional reserve banking comes in.
Fractional reserve banking, that sounds a bit risky.
It can be. It works like this. Banks only keep a fraction of the money people deposit in reserve. The rest they lend out, which actually creates new money in the process.
Wait, so banks can just like create money out of thin air? How does that even work?
It's a little complicated, but yeah, essentially. When a bank lends money, it creates a new deposit, like in the borrower's account.
Okay,
And that increases the money supply.
I can see how that could be a problem.
It does have some risks, yeah. Fractional reserve banking has benefits, though, too, right? It makes it easier to borrow and invest, increases liquidity in the economy. But if a ton of people try to take their money out all at once, the bank might not have enough in those reserves.
Right.
That's how you get bank runs and the whole financial system gets shaky.
And I'm guessing Mises had some thoughts about this system. Didn't he have strong opinions about central banks too?
Totally. He was really critical of fractional reserve banking, and especially central banks, the ones that try to manage the money supply and interest rates. Mises believed they could really mess things up, like distort the signals in the market so much that it leads to these artificial booms and busts.
So how do central banks even fit into this whole picture?
They're big players in modern economies. Central banks control how much money is out there, they set those interest rates, and they act as a lender of last resort for the regular commercial banks. They're kind of steering the whole ship, monetarily speaking.
Sounds like a lot of responsibility and a lot of power, maybe too much.
Exactly. Mises was super skeptical about whether they could actually manage things effectively. He thought their meddling often did more harm than good, leading to those boom and bust cycles we keep seeing.
Can you tell me more about that? Like, what causes these cycles to happen?
One of the biggest things Mises is known for is his Austrian business cycle theory, or ABCT. It explains how all this artificial credit expansion by central banks creates booms that are just not sustainable. And then, they lead to busts.
Artificial credit expansion, what does that mean?
When a central bank sets interest rates lower than what the market would do on its own, it basically makes borrowing money super cheap. So businesses start taking on a lot of debt. This fuels a boom, lots of investment, and economic activity.
So on the surface, that sounds like a good thing. What's a problem then?
The problem is it's all built on a shaky foundation. Those artificially low interest rates really distort the signals the market is sending. It leads to malinvestment.
Malinvestment. Can you give me an example of what that looks like?
Imagine a company decides to build a huge factory for fidget spinners, right? But they do it right before fidget spinners go out of style. It seemed like a great idea at the time, but it was based on bad information, distorted signals. The low interest rates made it look like there was way more demand for fidget spinners than there really was.
So they put all this money into something that wouldn't actually make money in the end.
Exactly. And this happens all the time with malinvestment, just on a bigger scale.
Okay.
So eventually this boom that was all fueled by cheap credit starts to fall apart. The bad investments become clear, businesses go under, and the economy shrinks.
So that's the bust.
Yep, that's the bust part of the cycle.
So this Austrian business cycle theory is saying that central banks, when they try to manipulate interest rates, are actually the ones causing these booms and busts.
That's the main argument, yeah. Mises thought the best way to avoid this whole mess was to have what's called sound money and let markets figure out interest rates naturally.
You've mentioned sound money a few times. What exactly does that mean?
It's like a monetary system that's really tough to manipulate and resistant to inflation. Historically, the gold standard, using gold or silver, was seen as sound money because it puts a limit on how much governments and central banks can just print more money whenever they want.
So Mises was a fan of the gold standard.
Definitely. He saw it as a way to protect individual freedom and keep the economy stable.
Interesting.
He thought that these fiat currencies, the ones that aren't backed by anything real like gold, are too easy to manipulate. Plus, they tend to lead to inflation.
It's a different way of thinking about money than we're used to.
It is. But Mises goes even further. He says that sound money is actually crucial for individual liberty.
That's an interesting idea. How does sound money connect to individual freedom?
Mises argued that when the value of money is stable and predictable, it gives individuals way more control over their own economic lives.
Okay.
They can save for the future and actually be confident that the money will be worth something later. They can invest without worrying about inflation eating away at their profits. Basically, they can make choices without being at the mercy of whatever the government decides to do with monetary policy.
So it's like sound money empowers individuals by limiting how much the government can interfere in their economic decisions.
Exactly. It creates an environment where people can succeed based on their own skills and choices instead of being stuck dealing with a messed up system.
The powerful argument.
Yeah.
It makes me wonder what Mises would think about our current monetary system, with fiat currencies and such powerful central banks.
I think he'd be pretty concerned about how much control central banks have over the economy and about all the potential for manipulation that comes with these fiat currencies.
Okay.
He might even point to the inflation we're seeing now as proof that a system without something like gold to anchor it is just inherently unstable.
It's certainly a lot to think about. We've covered so much today, like from where money came from to how complex banks are and all this stuff about the Austrian business cycle theory. Mises' book, The Theory of Money and Credit, is a tough read, but it really gives you a unique perspective on all these fundamental economic ideas.
It does, and I think what makes it so interesting is that it connects these theories to, real-world consequences for people. It shows how it affects society as a whole.
Absolutely. It's not just about like numbers and charts. It's about understanding how what the government does with money actually impacts our lives. So what do you think are some key takeaways for our listeners?
I think the biggest one is to understand how much power money has and how much it affects us every day. Mises' work really pushes us to think critically about the money system, the one we're all using, and to consider what happens when people try to manipulate the value of money.
It also makes us think about how important sound money is, not just for a stable economy, but for individual freedom too.
Exactly. It reminds us that money isn't just some neutral tool. It can be something that empowers people or something that makes them totally dependent on whoever controls it.
It's a powerful point. It makes me wonder, what can we even do as individuals to support these sound money ideas and protect our own economic freedom?
That's a great question, and it's one that Mises wrestled with too. I think the first step is just learning more about the history of money, how it works, all that. The more we understand about money, the better choices we can make for ourselves, and the better we can advocate for policies that make sense. We can also get involved with groups and stuff that are pushing for sound money. There are more and more people who are worried about how things are going now and want to change things for the better.
And of course, we can vote with our wallets. Like choosing to hold on to things that aren't so affected by inflation, like maybe precious metals. That's a way to kind of opt out of the whole fiat money system.
Those are all great ideas. The key is to be more aware of how money affects our lives, and to do something about it. Try to shape the monetary system in a positive way.
Well said. I think this has been one of our most interesting deep dives yet. Mises' The Theory of Money and Credit is definitely tough, but it's so insightful. It really helps you understand this world of money and what it means for our lives.
I completely agree. It's a book that makes you think, even after you've finished it.
For those listening who want to explore these ideas more, we've got a link in the description where you can buy The Theory of Money and Credit. It'll challenge how you think about things, for sure, and give you a deeper understanding of how money really runs the world.
It's a must-read for anyone who wants to get past the surface and really see the forces at play in the economy.
And as always, if you enjoyed this deep dive, please hit that like button, subscribe to the channel, and tell your friends. Until next time, stay curious and keep those questions coming.